What most people want is the same thing. They want to be comfortable. They want to have money. They don't want to have a whole bunch of contingencies in their life. They try and find what logics to them rather than what would I like to do.
All right. For the first time on the Owner Meeting Podcast, we have a repeat guest, the original business partner, Mr. Cody Davis. Cody, how's it going, man?
Going well. I made it all the way back for round 2.
There we go. And a lot has changed since you were last on. When we first had you on, you moved to Tennessee. You were dating a fantastic girl. You had expanded your portfolio. You were working a hotel conversion. There's a lot of stuff that you were working on our last episode. You're not in Tennessee anymore.
Not in Tennessee. I told that fantastic girl she couldn't be my girlfriend anymore. So now we're engaged.
There we go.
Being married. And that's coming up later this year. And living by the portfolio. So working more hands-on with the other owners I built relationships with and continuing to grow.
Dude, well, congratulations again on getting engaged. And you're now in Moses Lake, where the whole adventure started, more or less. Grant County. You did a deal in Quincy, a lot of deals in Moses Lake. Your girlfriend went across the country with you to Moses Lake, Washington. That's roughly the middle of nowhere. How did that conversation look for like, hey, I got some rentals over here. We're going to move to Moses Lake. How did that get agreed upon?
Well, it's about a step in the right direction. So our family lives primarily on the West Coast. Tennessee is not quite the West Coast, and Moses Lake was a heck of a lot closer. So it was a stepping stone with the plan of let's spend 2 to 3 years getting from the financially free from a job position to the more affluent position, be hands-on so we can cultivate the relationships, continue to grow, and then we'll move where our family actually is, which is that Gig Harbor, Tacoma, University Place area. But it's more of a stepping stone toward where we'd like to be, and it enables some business decisions that allow us to go faster.
A question we get with a lot of landlords is, okay, is there a notable advantage to being in market? And you have an interesting perspective. You started in state, but not in market, about 3.5 hours away from your portfolio. You moved across the country from your portfolio, and now you live literally in market where you can touch your properties in a 10-minute drive. What has that done for your portfolio? Has that been a notable thing? Is that something you recommend people do? What is the difference between those 3 different states of proximity?
Well, living nearby is convenient for value add projects. We've done some value add projects locally. It's been nice to be able to go see those regularly, see where they're at. However, for my stabilized projects, I don't really go see them very often. Even Quincy, I see maybe once a quarter, and I only live 40 minutes away. But it's been so stable in the past couple of years that I don't need to go see it. The income comes in. When maintenance things pop up, I send someone out, they send photos, and it's done. So from a value add perspective, being hands-on, seeing everything makes it much more, makes it a lot easier to move forward with confidence on the projects. Once everything's stabilized though, I don't see a need to be here locally. I'll just come visit the properties once a month, and more so the properties, visit the owner relationships that I've been.
Yeah, that's what I was really curious about. So when you're living in market, what impact has that had on the owner relationships that you have? Because you didn't have a problem creating a lot of owner relationships when you lived out of town. You bought a lot of rentals purely off of the relationships that you built. What was the difference between, hey, I have close relationships and don't live here, and hey, I now moved here, I'm at the properties? I imagine that probably had some impact on the relationships that you'd already developed.
It had a lot, because more so than just having the relationship with those close individuals that I met 5 years ago, now I've been introduced to friends of those individuals, and that took it one step further. I've met their families, I've met their friends, their business partners. And some of those people are farther along than the people I met originally. Not all of them, but I've gotten unique opportunities from being here because of the people I wouldn't have met. Because those people don't own the types of assets I was calling on. They don't own the mid-sized multifamily, but they own a tremendous amount of other assets that I didn't even think about. in the beginning. So just being here opened up a lot of doors.
How fast did that happen in comparison to I'm setting up owner meetings, I'm driving over the mountains? How fast did those relationships develop when you lived in market as opposed to when you were out of town?
The new relationships took about 60 days from when I moved here. Within 60 days, I had met people that I never would have met otherwise that are tremendously further. They're just way farther on an investment standpoint than I thought there was in Moses Lake from the typical people that I had been meeting with. And so that was a cool opportunity, but it happened rather quickly. And I will say it only happened quickly because of the relationships I had already built over the course of the 5 years. It's not like it just dropped in a market and instantly happened. It still takes time to cultivate those, but having that foundation enabled some unique conversations once I actually moved here.
This is why people need to always be working the relationship game. Whether you're in market, out of market, there's always a bigger fish and there's always another level. It's so much deeper than you think. And there's rooms that you didn't even know existed that you're not in yet because you haven't made those first connections. And those first connections, at some point, you do enough and you move to the next level, you move to the next level, you move to the next level. But I've talked to people. I had a phone call recently with someone who's like, "Oh yeah, one of the largest oil families in Dallas is a good friend of mine." I've talked to him about multifamily, and he's like, "Yeah, you're probably not going to get into the rooms that we're in your lifetime. It's like three generations, and there's levels that he's not invited to yet. And the guy he's talking about is worth about $7 billion. There are levels upon levels upon levels, but you do progress a lot faster, I think, if you have proximity to your properties. The relationships of, hey, I can get a coffee in 10 minutes as opposed to, hey, let's schedule time next week. That cuts out a lot of time.
It does. And it's interesting to see that I've moved next to my rentals and you've moved your rentals next to where you live.
Yes, which has been an adventure. It's interesting being I love a lot of my properties out of state, and luckily I'd stabilized most of them, not all of them. A couple of ongoing projects, but we were mostly stabilized when we made the move, which puts us in a more similar position to your Quincy property, where it's like, hey, once a quarter, be good to get out there. Now, last time I tried to do that, we got snowed out, and I had a newborn, so that didn't work. But you want properties that are large enough to where it's worth traveling out once a quarter. But a stable property, it doesn't take that much time. Has your proximity to your properties today dictated the type of projects that you're wanting to take on while you can get more hands-on?
The value add side is ideal. There's not a lot left though. And we cleaned up a lot of Grant County. And there's going to be some, and you and I are mutual on a 9-plex, which you'll probably buy, and an 8-plex that I'll probably buy. But outside of that, I'm working on transitioning my equity from those types of assets into the newer stuff where I can set it, forget it, not think about a lot of the CapEx, because I'm in a transition period where I got bought out of multifamily strategy and moved across the country, and I got to figure out what the next business thing is so that I don't die. You know, you stop working, you die. So it seems. So I got to figure out the next piece of that journey. And so my thought is, suck all the equity I built in these older properties, move it into newer, nicer properties with metrics that cash flow on long-term fixed rate debt. And that'll take my focus off of the value add into what do I do next? And I think it is going to be construction. I have a feeling that is the next segue. And so owning the new assets, when I go into building, I can think about what do I like about my new construction multifamily? What do I not like? And what would I do differently on these new builds that I'm building to keep or building to sell for a profit?
Well, and that's interesting because when we first met, which was about 5 or 6 years ago now, you were talking about wanting to get into development. You had a mentor who had a fairly similar path. In fact, you ended up with a lot of his properties as you built your portfolio. Why wait as long as you did to get into development, and why is now the time that you're approaching that?
Well, it's from a place of stability. I don't want to just jump onto the next thing without having my foundation. I wanted to have a very solid foundation. That's something he told me a long time ago. He said, you get your rentals, you get the cash flow, use the cash flow to weather the storm when your developments don't go right, because developers are the richest people on planet Earth until they lose their project and they can't finish it. So I wanted to build a stable business, and I'm just getting there. I was reviewing all my debts I've paid down and paid off last year. There was a few I forgot about, but I paid off like 300 something thousand on my side of the portfolio and just investor debts last year, and continue to knock those out. I'm halfway done paying off all my investors. When they're paid off, that's when that real transition happens for the development side, because I truly don't like owing people money. I like owing banks money, or owing the seller finance notes on the real estate. So I would have done it sooner if I had a place of stability. But as you know, more so than most, it takes a lot of money to do what we did. And I borrowed a lot of money to get to where I'm at. And I wouldn't change it, but it was the game that we chose to play. And so once those obligations are cleared, that enables a place of stability to go do what my mentor did. And he passed 6 figures a month in net cash flow with very low debt. And I'd like to emulate that, but he didn't have all these investor obligations and he didn't go as fast. So we're just trying to stair step it in a way that doesn't tank me.
Well, and by the way, for those listening, borrowing a lot of money, it's, 20, $30 million, somewhere in that range of capital that was moved to build the portfolio that we built together over the last few years. Cody and I have separated out a lot of pieces. So I have some, he has some, we have some projects together. We're under contract for stuff together. But if you're trying to build something relatively quickly, which both he and I had a goal of, hey, we want to hit financial freedom roughly now. We moved very, very fast. I'm a huge fan of what we call the debt hammer, which is you build the cash flow first, you stabilize the universe, you optimize what can be optimized, which I would argue your 1031 strategy is going to do, taking your rougher, older properties and turning them into newer, stable properties. I think that's a big piece of the optimization phase. You're tailoring the portfolio to be more passive. You hammer the debt, and then what's the next thing? And for Cody, it's go out and build. Cody's through more than half of the phases now. Now it's transition to optimize and roll down that debt. That's awesome, man.
Yeah, I'm excited. It'll be a fun new phase. I still got another 450,000 in investor debts outside of the Robinhood. So once I clear that, on to that game. But we'll get there.
Now, when I first met you, you were trying to, a little bit of Cody's backstory. He accepted about $500,000 of bad debt from a partner to get out of a partnership. That partner was defaulting to other people. Cody said, if I take on your obligation, can I have your equity? And Cody overcame that $500,000. You have about that left. How much different does it feel needing to make $500,000 when you're already here, as opposed to the first time you had to make $500,000?
Well, the first time was awful. And that was a very painful experience because I didn't have any reserves. Now I have a little bit, not much, but relative to the business I have, but I didn't have any reserves. I didn't have any cash flow that I paid myself. My rent was double what it is right now back then. So, I was paying a lot more just to live. It was tough because back then I had 30 rentals, I think. Well, and then we had our stuff. So I was probably at 81 rentals when that happened. And now I've got a little over 100 rentals, having sold out of a bunch of stuff. But I own a lot of them myself, or own the majority, and they're cash flowing, which is helpful. So
yeah, your unit count went up a little bit, but your equity went up astronomically. You bought out a lot of partners on what you own.
But yeah, that was expensive too. But bought out a lot of partners, own the stuff for the most part myself, and I've got a 50-50 partner on some of them, on the bigger property, a 38 plex. But yeah, it's easier now to fathom it. I was thinking about that this morning because I paid off. I was at 550,000 in debt this morning, and I paid it down about $100,000. So now I'm at 453.
There we go. You're ahead of me. I only paid down my debt 55,000 today. It's a good day for Cody and Christian. We lets people money. Isn't it funny how the context changes in so few years, though? That used to be such a huge sum, and we're not that far into business. I mean, like, hey, we moved the needle 6 figures on what we owe. That used to be so unbelievably hard to do.
Times have changed. The perspectives have definitely changed, but the goal hasn't, which is nice. We're still going the same direction. But when I saw, for context for those who are watching, Chris and I were doing a motel conversion. I just got bought out of that. And I scraped by with a 6-figure payday. It was exactly 100 grand, just over 5-figure mark. And that was the first time I ever had that amount of money hit and nothing, there was no emotion at all, which was odd. But yeah, times definitely change as the assets grow. And I'm glad that I have the base I have to knock out that 453. And it's not just an exact repeat. It's almost the same amount of money as 3 years ago, but it sure feels different.
Mm. How it's fun watching the growth. So you're getting into development. What does development look like for you? Is that going to be in Grant County? Is it going to be somewhere else? Do you have a specific plan of what you're going to develop first? I'm curious how thought out this next phase is.
Yeah, I've already got the land. The 38 plex, which we took down, you eventually got bought out of. The person who bought you out is a builder and my mentor. And he's like, well, why don't we build here? I was like, well, we're on septic. I said, well, let's just connect to sewer. It'll work out if we build this amount of units. We can fit it on this land. And so his thought is build 2 10-plexes right behind the L building on the drain field.
Yeah.
Because we don't have the drain field anymore.
Oh, that's so clever. That's so clever.
So clever. And it works because it doesn't mess with the road. And we have enough room for parking. So we put up a 10-plex, refinance it because we can get it the cost low enough, and then build the second 10-plex. And now the 38 unit becomes a 58 unit. And that would be a soft intro to development for me. And it'll work because my partner is my mentor and builder, and he knows a thing or two about a thing or two. So I think that'll be the first project. And by then, hopefully Broadway will be on sewer. And then that would be the next 10-plex development site.
One thing that we've always had as a core principle: get around people who've done the thing you want to do. And that's going to cut down on your stupid tax a lot. Cody and I, early in our career, bought a resort without consulting anyone who's ever owned a resort, except for the person selling us the resort, who had a direct counter interest to us. They wanted to sell it and we wanted to buy it. We didn't get someone who knew what they were doing to benefit from their experience or to underwrite with us or any of the things that would happen. If you're going in development, you're doing a new chapter. I mean, that's exactly what you do, right? You bring on another partner or you have another mentor at least walk you through it. But I mean, that's the correct way to do it. You bring the experience on the team for the new venture that you want to go on. You establish it, you plan it out. And it's great when you can use the pieces that you have. It's awesome that you guys already have the land available. You just had to make some maneuvers. And that building on sewer is going to be sweet.
Yeah, and the sewer cost will go up a lot. I mean, we're going to go from, because right now our rolling average is $1,000 a month, 12 grand a year for septic. Because the tanks and the field are not exactly ideal. But we're pumping it a lot, and I think the cost will go from $1,000 to probably $4,000 a month. But once we build it, in excess of the new mortgages and debts we're taking on, the net cash flow should go up, net of those fees, about 10 grand a month, which would be substantial.
Yeah, I would say an additional 10 grand a month on something you already own. How many units do you say you were planning on adding to that? See, and that becomes a different class of asset. That 50 plus, you're valued a little bit differently. You're typically going to lower the cap rate just for being that size. You have a little bigger buyer pool above 50 units, more income, and it's going to look so much nicer having some new buildings on that campus. You have some like medium newish buildings. You have a really old L building. You had some brand new buildings. You have a really interesting, basically you've built an entire neighborhood at that point. 50 plus units.
And the L building's getting a pitched roof. once it's refinanced in 60 days or so, it's going to get asphalted. So we're getting new blacktop, and so using the refi funds to do that. But once it's on sewer, all the buildings are newish and pitched roofs and asphalted. It qualifies for better debt products, and it should be a far superior asset to the little 38 flex that made $5,000 a month gross when we bought it.
Now here's a question. You're 1031ing some of your assets or looking to into newer buildings. You're also developing on this campus. You finish your development. Is that one where you refinance, or is that one where you sell and you look for something newer? What's the exit plan after you develop?
Well, with those builds, anything, I have a strategy based on the owner meetings I've had, and I want to get to 75 plus units per campus eventually. So it's a matter of where's the debt market at, if I need to refinance or if I need to sell. My plan, assuming those townhomes go up and we get that 38 flex into a 58 flex, likely would refinance at that point, hold it for a few years, and 1031 into a much bigger asset, because that's going to be, and by the time we sell that, it'll probably be 150 to 100, well, actually probably 180,000 average price per unit, because the new builds are going to be like 275 and the older stuff's going to be less than that. But even just putting that on a calculator, 180 grand a unit on 58 units. I don't have anything that big. Let's see. That's a $10.5 million asset. So, and with that type of asset, once it's paid down a little bit, collect cash flow for a few years, could go buy a sizable out-of-state building. I don't know what the price per unit you're paying on your really nice stuff in Texas, but something like that would be cool to take down without a whole syndicate of partners.
Yeah, my last two bigger deals are 44, and we just went under contract for a 79. They're nicer, but they're LIHTC. So the price per unit, I mean, we're coming in. One of them was like 45 a door for Class A, but you have the restriction on it for an extended period of time. Cash flow day one, they cash flow about 10%, which is great, but you're holding them for the long term. And when you exit that program, rent's basically 3.5x, which is muy bueno. You just have to wait. So it's a very specific partnership. So mine's probably not a direct comparable, right? I'm buying new buildings that have a very specific restriction on them. So my price per unit is what it is. But Stephenville, Texas, a decent building, if it's older build, say like 1980s to early 2000s, you're probably coming in somewhere around 100,000, 110 a door for very decent inventory.
So my thought would be then eventually I could exit the asset around, net sales price in the high nines. I walked away with $4 million, go buy a $12 million asset, go get 100 units somewhere. And at that point, that should be stable enough with on-site management that I can go do some more smaller developments and then position a portfolio to try and do the same thing. Because I'd like to get to that 75 plus unit legacy property. And I think that there's a lot of potential to get there through development over the course of a decade or so.
One of the things that I think is really interesting is that concept of legacy property. We built a business off buy and hold real estate, and we've bought duplexes, we bought triplexes, we bought fourplexes. Well, actually, it was a triplex named fourplex. We bought 12s, we bought 38s, we bought a whole lot of stuff. Legacy property, you said 75 and up. How did you come up with that number?
All numbers are made up. That's the first thing that we have to establish.
How did you make up that number?
I met up with an owner whose family owns, they're probably north of it now, but about 1,000 units in LA. And they didn't syndicate. That's just picking up stuff, value add, and then buying nicer and bigger properties that are $10, $15 million chunks. They've done that over a long time. And he talked about how you manage leverage based on what generation of investor your family member is and the goals. And then they talked about the size of property that is most ideal to be able to pass on, hence the legacy piece. And the number that was thrown out was 75 units. The thought process was a 75 unit in a decent market should have a net operating income of at least $500,000. $500,000 is enough money, even if half of it went to debt, for whoever inherited it to not have to work. If $250,000 went, you have 900 to 1,000 a year in total rents, 1,000 a unit, 75 grand a month, 900 a year. You're probably netting $500,000. And if you're at a somewhat respectable leverage, you're going to have $250,000 in debt payments. Then you net $250,000, 20 grand a month, adjusted for inflation. Your kid or your wife or your husband, whoever inherits it, will have enough and that's your legacy. You set them up forever. So that's the goal I'm shooting for, is to get to that mark. It will make enough money if I own it without a syndicate of partners. And to be fair, the 58 unit would make enough money to do the same thing, but the idea remains the same. Get something that is big enough to warrant, this gets passed on, that family member or that group of family members is not going to have to struggle with money ever again.
Yeah, that gets to the concept of don't eat the golden goose. So many people will lose their portfolios within 1 to 2 generations. And a lot of people who've sold us real estate, they're seller financing specifically because their kids don't want the real estate. They didn't care. They were never trained to have them. You're just about to get married. You're quite young. But as you're building this size portfolio, you give any thought to like, okay, how do I build a legacy property, and how am I going to train my kids, train my family, train whoever inherits this? Are there any guardrails they're going to put in place to make this easier to manage, and an operating guide or a plan on, hey, if you don't mess this up, if you don't sell it, you're set for life?
Yeah, I'm trying to create solid principles first, because you can't pass something on that you don't have. So first step is build the business. For me, I got to build it. And I built the business off of old crappy properties and no fault to the prior owner. They built a life that very few could fathom having, but they did it with these older properties that were run down, and they played with the pieces that they had. And I've gone in and made them nice. Problem is, if I pass those on, my kids are going to own renovated properties with very old bones. So the first step looking forward for me is to upgrade all those assets with very high leverage today on long-term fixed rate debt that cash flows with margin. I'm trying to, now that I built a little bit of equity, I'm trying to get as many assets as I can by myself. As an example, trading a $600,000 asset with 150 grand in equity to buy a $1,650,000 asset. I'm just trying to increase those numbers and improve the cash flow, because my appreciation and my cash flow multiplier is going to be a lot higher on a $1,650,000 asset than it would on a $600,000 asset. So looking forward, I'm trying to grow that number on the personal side, non-contingent of partners. And that way I can eventually get to those legacy size properties. And when it comes to raising kids, my thought process is play the games, make them understand, like the cash flow board game, make them understand a balance sheet and how a financial statement works. And then really illustrate to them that what I have at that point is a result of buying the stuff that nobody wanted. And that their success is going to really be determined by their ability to, number one, communicate, and two, slightly less important than communication, see things that are in plain sight other people don't see. And if they can't see those, they're going to struggle in life. And if they can't communicate, they're going to struggle even more. Because I came from a background of being an introvert, not understanding how to communicate with people, how to make concise thoughts when it's really needed. And as soon as I figured that out and started working on it, life got a heck of a lot easier. So I'm going to make sure that that is instilled in them from a young age.
If you're, assume that you're not one of your kids, your future kids. If you're trying to learn the most efficient way possible, how do you find opportunities that are in plain sight? That is an incredible skill. You mentioned you built an entire portfolio out of properties that no one wanted. You've made millions of dollars doing this. You've set up enough cash flow to be able to live quite comfortably. And you're getting to the phase now where you're like, hey, I've almost hit stability in not that long. And I'm starting to look at what's next. I'm looking at development. That all starts with the ability to find opportunities that are in plain sight. How do you teach that at the level that you teach a kid? So someone's listening to this pod, like 101, how do you find things that are right now in plain sight in your market?
The question I would propose is, resources aside, what do you want to do? And you figure out what you truly want. The laziness in a kid, they have so much energy, but kids don't want to just grind things out. I've never met a kid that just wants to grind and grind and grind. They may love the sport, or they may love academics, but they're not going to grind on something they don't like to do. So kids tend to find an efficient or lazy way, that's what I did growing up, to get a good enough result. So I just figure out, what is it that I want? And what most people want is the same thing. They want to be comfortable. They want to have money. They don't want to have a whole bunch of contingencies in their life. And they try and find what logics to them rather than what would I like to do. So I always go back to that question, what do I want to do? And a real life example, something that I'm going to do that is plain freaking sight, but nobody's doing it. As soon as I buy the 7-plex, there's a ton of them. I think there's 26 of them going up in total. What do I want to do? I want to stay rented. I don't want to have a bunch of turnover. I want to have that consistent income so that I'm comfortable. Nobody's put up a monument sign. So as soon as I buy the 7-plex, I'm going to spend $3,000, get a monument sign with lights, and put a phone number. So every time someone drives by all those different 7-plexes, I may only own one, but I get associated as the company that manages all of them. So every time someone drives by the Marina Townhomes, they're going to think, well, that sign, that phone number, it's in plain sight. Nobody did it because no one owns them all. But I'm like, I don't need to own them all. If I become associated as the person who manages them all, they're going to call even when there's a vacancy sign outside of another one. It's in plain sight. It gets me consistent income. It only costs $3,000. And once it's done, it's done. And now I get branding for a $40 million development when I only own 7 of the units of 190 something. That's a plain sight example, but it gets me what I want. What do I want? I want the consistent income for not a lot of money.
Is it fair to say the most effective way to get creative and find an opportunity that other people are missing is typically the least creative answer to the question? What's the simplest way to get more traffic to your building? Put a sign out in front that no one else has. Like it is such an easy answer, and it's a missed opportunity. It doesn't take a genius to figure this out, which is why I love the strategy so much. This is why Cody and I first partnered. It's like, how do you take out a 38-plex? What does the seller want? They want $10,000 a month. The property doesn't do that. Let's pay less for 6 months and then start paying 10 when we fix it. Ta-da! Creative finance and creative opportunities and creative marketing. I think the answer every time is, how little creativity can you inject between, here are my goals, and in a transaction, here's the seller goals. Or if you're playing against someone like you are in marketing, here's an ocean of 7-plexes. How am I competing? This is what they're doing. This is where I'm at. What's the simplest answer? That's how you get creative effectively.
And it's that shared authority. People have imposter syndrome when they're getting started. There's so many properties out there where there's a sea of 4-plexes and they buy one, and there's no branding for it. So just put up the branding. If it's on a Soton Street, a Soton quadplexes, don't make it plural, and put your phone number on the sign. And now every time someone drives by, you get the exposure because people think all these properties are just owned by mega companies. They don't realize it's owned by people. They assume, okay, all these quadplexes on our Soton, this is the number to call. It's plain sight, but nobody did it, and nobody will do it. So being able to spot those things, it is, like you mentioned, very simple. And nobody does it. It's in plain sight.
Do you have a good example of a time where you've gotten too creative, where it did the opposite of what you were trying to do? You're trying to be clever, trying to get creative, and instead of finding the simple answer, you found an overcomplicated answer?
Oh, I don't think I've ever gotten too complicated. There was a couple times where it could have been. Walla Walla would have been too complicated for sure. But even on the deal that didn't go well at the Robin Hood, it just great asset, not a great fit for the equity group, how we put it together. It was a great structure. I don't think it was too complicated. I think it was simple enough. The deal just didn't go as we expected.
Yeah,
So
sure.
I don't think there's anything in my portfolio that was ever too complicated. Walla Walla would have definitely been too complicated, but everything for the most part is pretty simple. You find the deal, the debt, the equity, like we've taught at MFS for years. You keep it simple and you execute on the business plan. We've done that consistently on every deal. Walla Walla, we probably would have made a ton of money, but it was really complicated.
For those who are like, what is the Walla Walla deal? It was a 60-unit transaction, one big building, a bunch of duplexes and houses, an additional house that another owner in the family owned. Some of it was seller finance, some of it was bank finance, some of it needed a reno, some of it was turnkey, and it was in a market that we had never invested in our lives. We had no teams, nothing. That would have been wild on the deal structure, on the refinances, on the renovations. I am so glad in retrospect that we did not do that deal. That would have stretched it. We were already stretched thin because it was after we did the Robin Hood. So we had 2 asset classes. We were trying to figure out one while we were doing really well in multifamily. Had we opened a new market in 60 units on that complicated structure, that would have been very, very, very difficult to execute on. That was a deal that could have tanked us had we executed on that.
Yeah, absolutely could have, probably would have. And so I'm glad it worked out the way it did. It was a bummer back then.
It was. It's funny how those things tend to work out, though. I mean, I realize not everyone's business works out, but generally speaking, for us, the things that needed to happen have pretty much happened throughout our entire career.
Yeah, we'll see if that continues to be true through the end of this year.
And we say that every single year.
The problems get bigger and the payoffs get way bigger, so it's worth it. But yeah, to your original question, nothing's been too complicated. We've done a very good job at keeping things simple.
And if they're simple, they're repeatable, scalable, and I like being able to outscale our problems.
Yeah, absolutely.
Awesome. Well, Cody, thank you for joining us on this episode of the Owner Meeting. It's fun to have you back on. It's been a while. For those who don't know, you've probably gleaned this by now. Cody and I have partnered on a lot. Cody started multifamily strategy with me back in the day. He is an awesome investor, super, super smart. Still, I believe, the most watched episode of the Bigger Pockets podcast of all time. Yeah. So privileged to have you on, man. I'm glad things are going well. Again, congratulations on getting engaged. That is very, very exciting. I wish you guys the best. And we'll have to have you back on as soon as you start developing the next project. When you start putting up those properties, I'm going to want to see some pictures, maybe do an on-site interview. I want to see that thing go up. That's exciting.
Yeah, we'll do that. And then I'll share some stuff offline. There's some pretty crazy developments going on in town from some of those folks.
Oh, boy. All right. Well, thanks for being on, Cody. We'll see you all in the next episode.